If you have ever looked at the price chart of Bitcoin, you might have felt something almost paradoxical. One year, headlines scream that Bitcoin is unstoppable, soaring to the moon, minting millionaires overnight. A little later, those same headlines shift tone, speaking of crashes, fear, uncertainty, doubt. People panic, rage, mock, and declare for the hundredth time that Bitcoin is finally dead. Yet somehow, it rises again. It climbs, slowly at first, then suddenly, almost violently, as if awakening from a deep hibernation. Not long after, a new wave of euphoria floods the market, and history seems to repeat. This repeating rhythm, this pattern of rise and fall, hope and despair, fear and greed, is what many refer to as the Bitcoin cycle. But what does that really mean? Is it simply a coincidence? A collective emotional swing? Or is there something deeper beneath the surface? Something structural, almost coded into Bitcoin's very DNA? Many newcomers see these fluctuations as chaos, unpredictable and wild. But for those who watch closely, who trace the movement over years, not days, the pattern reveals itself. Bitcoin's story is not a straight line. It is a sequence of waves, and each wave tells a part of the narrative. To understand the Bitcoin cycle, we must first step back and see Bitcoin not only as a price on a chart, but as a system, an economy, a technological revolution, a response to monetary inflation, and perhaps even a social movement. Every cycle is shaped by these forces. Every surge and crash carries meaning. Let us start at the beginning, with the first beat of this rhythm. In 2009, when Bitcoin quietly emerged after the global financial crisis, almost no one believed it mattered. One Bitcoin was worth less than a penny. It was just an experiment, a curiosity for cryptography enthusiasts. But in that small corner of the internet, something was born. Something limited in supply, decentralized in structure, and immune to the traditional control of governments and banks. Its supply was fixed. Only 21 million coins would ever exist. This simple constraint would later become the spark that ignited every cycle that followed. The first cycle was modest, almost invisible to mainstream eyes, from cents to a few dollars. Then a crash. It looked insignificant then, but it was the first sign of what Bitcoin could become. Over the next few years, awareness grew, adoption spread. When Bitcoin crossed $1,000 for the first time, it felt unreal. And yet, as quickly as it rose, it fell, hard. Many called it a bubble. They laughed, they walked away. But Bitcoin did not die, it waited. Years later, the second dramatic cycle arrived. 2017, a global frenzy. Ordinary people opened exchange accounts, friends talked about it at dinner tables, and the phrase buy the dip became a cultural slogan. Bitcoin reached nearly $20,000 and became world news. Then came another crash, a long winter. Some disappeared, disillusioned. Others stayed. They studied. They learned. They understood that Bitcoin's movement was not random. It was cyclic. Then, 2020 and 2021 brought a new cycle again, driven by institutional interest, macroeconomic changes, and digital transformation accelerated by a pandemic. New all-time highs, more excitement, more speculation, and of course, another painful downturn followed. People called it the end. Again. And yet, here we are, still asking the same question, still watching the same rhythm return like ocean tides. So, what is the Bitcoin cycle? It is the repeating pattern of boom and bust that Bitcoin has experienced since birth. It typically stretches across several years, and though it does not follow a perfect clock, it carries a familiar structure: accumulation, expansion, euphoria, decline, despair, and recovery. Each cycle feels different in the moment. Each feels unique, influenced by new players, new technology, new regulations. But when viewed through a long lens, the similarity is undeniable. It is important to understand that the Bitcoin cycle is not just a financial curiosity. It reflects something fundamental about human behavior. We are drawn to opportunity when others celebrate it, and we run from it when others panic. Markets amplify our emotions, turning whispers into roars. Bitcoin, being young and still volatile, magnifies those emotions even more than traditional markets. But the cycle is not only emotional. Something more mechanical pushes it forward, something programmed into Bitcoin's core, something that controls its supply. And that leads us to the most critical pillar of the Bitcoin cycle: the halving. Every 4 years, the number of new Bitcoins entering circulation is cut in half. This predictable reduction in supply has historically preceded major price increases. Not immediately, Not overnight, but like a seed planted in soil, it grows with time as scarcity intensifies. To understand why this matters and how it shapes the cycle, we must dive deeper into what halving is, why it happens, and how it influences price. Because the Bitcoin cycle isn't only about charts or emotions, it's about economics, it's about scarcity, it's about the unstoppable math of limited supply meeting rising global demand. So now, let us move forward into the heart of the mechanism that makes Bitcoin cyclical. Let us understand how halving works and why every major rally in Bitcoin's history seems to follow it like a shadow. Welcome to the second part of our exploration. To understand the Bitcoin cycle, we must walk into the core of its design, into the place where mathematics meets economics, where code shapes behavior, and where scarcity becomes not a flaw, but the very foundation of value. This place is known as the halving. Imagine a digital asset with a fixed maximum supply. No printing press, no central authority deciding to loosen monetary policy, no emergency stimulus packages that dilute your savings. Instead, imagine a system where every new unit entering circulation is created according to transparent rules written into code, rules that cannot be changed without global consensus. That is Bitcoin. From the moment Satoshi Nakamoto mined the first block in 2009, the supply path was already defined. Only 21 million Bitcoins will ever exist, not one more. But what makes Bitcoin scarce is not just the cap itself, it's how new coins enter circulation and how that process slows down over time. When miners validate transactions and secure the network, they are rewarded with newly created Bitcoin. This reward is the incentive that keeps the decentralized system alive. But every 4 years, roughly every 210,000 blocks, something dramatic happens. The reward is cut in half. This event is the halving. It means that the faucet of new supply tightens, like a river shrinking into a stream. In the early days, miners earned 50 BTC per block, then 25, then 12.5, then 6.25. After the 2024 halving, just 3.125 Bitcoin are created with each new block. Scarcity deepens with every halving, and history shows a striking pattern. After each halving, once the market digests the shock of reduced supply, price tends to rise significantly. Not instantly, not automatically, but gradually as fewer coins are created while interest continues to grow. It is like a slow-burning fuse that eventually reaches a powder keg. Look at the past cycles. After the 2012 halving, Bitcoin surged from around $12 to over $1,000, a spectacular early cycle. After the 2016 halving, it climbed again, from hundreds of dollars to nearly $20,000 in 2017, a rally remembered as the moment Bitcoin entered mainstream culture. After the 2020 halving, institutional investors stepped in. Tesla, MicroStrategy, hedge funds, countries debated adoption, and the price soared to over $60,000. 3 halvings, 3 explosive cycles. The pattern is impossible to ignore. Of course, the halving does not magically create demand, it reduces supply. But when reduced supply meets rising interest, innovation, awareness, adoption, it sets the stage for acceleration. Imagine a marketplace where the number of apples decreases each year, but more people develop a taste for apples. The natural result is competition, and competition fuels price. Bitcoin's halving is a predictable supply shock. In most markets, supply shocks are sudden and emotional. Crop failure, mining disruptions, geopolitical conflict. But in Bitcoin, the shock is pre-announced. Everyone knows the date years in advance. And yet, time after time, markets behave as if surprised. Why? Because markets are not machines. They are made of people. People hesitate. People doubt. People wait for confirmation. And when confirmation comes, when price begins to rise, fear turns to curiosity. Curiosity to interest. Interest to FOMO. The cycle ignites not at the halving itself, but in the months after, when new supply becomes scarce enough that demand finally outweighs it. This delay is part of the rhythm. If the halving is the engine of scarcity, market psychology is the fuel. Early after a halving, the market is often calm. Prices may fluctuate, but enthusiasm is low. Some call it boring. Some declare Bitcoin dead. But in the background, long-term investors accumulate quietly. Miners receive fewer coins to sell, reducing downward pressure. Institutional players gradually enter. Builders continue developing technologies. Layer 2 networks, lightning payments, NFT experiments, decentralized finance all grow quietly during these periods. Then, slowly, price begins to move. A little at first, enough for analysts to take notice, enough for old believers to smile knowingly. As price climbs, media attention returns, new investors arrive, and the story spreads. The same story that has played out multiple times. Bitcoin is rising again. Momentum builds. Maybe there's something here after all. Momentum builds further. I don't want to miss this. And just like that, the calm transforms into excitement. Eventually, excitement becomes euphoria. Smartphones light up with price alerts. Conversations happen at cafes, offices, barbershops. Social media overflows with bold predictions. Ordinary people, not just traders, technologists, start buying, not because they studied Bitcoin, but because everyone is talking about it. At this stage, caution fades. FOMO replaces reason. Price skyrockets beyond fundamentals. Joy turns to greed, but no cycle is infinite. At the peak of euphoria, someone sells, then someone else. A famous figure tweets something negative. A government releases new regulations. Fear creeps in. Investors lock in profits. The price drops slightly. A few dismiss it as healthy correction. Then it drops again. Confidence cracks. The same media that once glorified Bitcoin begins predicting collapse. Panic grows. The downward momentum accelerates, and desperation unfolds. People who bought near the top capitulate. They sell at the bottom, believing the story is over. This crash phase feels like destruction. But in reality, it is renewal. It flushes out speculation. It clears excessive leverage. It returns the asset to long-term holders. Builders keep building. Believers keep accumulating. The network remains alive. And in the silent aftermath, early accumulation begins again. A new cycle is seeded. Halving, accumulation, expansion, euphoria, crash, despair, accumulation again. It is not a perfect circle. It is more like a spiral, looping forward through time, each cycle bigger in scale but familiar in shape. Understanding this mechanism is liberating. Instead of seeing volatility as insanity, we see structure. Instead of seeing chaos, we see rhythm. Instead of fearing downturns, we see them as chapters in a longer story. The cycle is not an accident. It is the consequence of fixed supply meeting human psychology. It is the heartbeat of Bitcoin. Now, as we step beyond scarcity and halving, we must face the human side of this phenomenon. Supply alone cannot move markets. Minds do. Emotions do. Herd behavior does. Incentives do. And in Bitcoin's world, emotions are amplified. Greed pushes price up faster than fundamentals. Fear crushes it quicker than logic. The same human instincts that fueled centuries of financial bubbles now play out on a digital stage. Which leads us naturally to the next question. What role does investor psychology play in the Bitcoin cycle? Why do people rush in at the top and flee at the bottom? Why does every cycle feel new, even though it mirrors the last? And what can we learn from these patterns that might help us navigate the future? Let us now step into the emotional core of the Bitcoin cycle, the powerful force of market psychology that rises and falls like tides. If scarcity is the engine that powers the Bitcoin cycle, human psychology is the gasoline that makes the engine roar. Without emotion, markets would move slowly, rationally, like a calm river. But Bitcoin is not calm. It is a storm, sometimes violent, sometimes beautiful. A place where logic and emotion battle in real time, where rationality bends, and where the oldest instincts of fear and greed write history on price charts. To truly understand the Bitcoin cycle, we must understand people. Imagine someone who first hears about Bitcoin during a hype phase. Their friend made money. Their coworker bought last month and doubled their investment. Social media is filled with charts pointing upward. Journalists compare Bitcoin to digital gold. Influencers promise new heights. In this moment, something stirs inside the human mind, not logic, but desire. A voice whispers, "What if I miss this? What if everyone gets rich except me?" This is FOMO, the fear of missing out, and it has launched countless investors into the market at precisely the wrong time. This pattern is not unique to Bitcoin. History is filled with speculative frenzies. Tulip mania in the 1600s, the roaring 1920s, the dot-com bubble of the early 2000s. When people see rapid wealth creation, they want a piece of it. They rush in not because the asset is undervalued, but because they believe the party will last forever. They see green candles and assume they will continue. In these moments, Bitcoin is not just an investment. It becomes a dream, a lottery ticket, a symbol of possibility. Rational analysis evaporates. Everyone becomes an optimist. But optimism has a dark mirror image. When markets rise, confidence grows. When they fall, confidence collapses. A 20% dip shakes some hands. A 40% drop breaks others. At 60%, panic spreads. People refresh charts obsessively, looking for signs of reversal. They watch the value of their portfolio shrink like a tide pulling away from shore. The same media that praised Bitcoin now predicts doom. Regulators issue warnings. Influencers grow silent. Fear grows stronger than reason. Eventually, investors sell, not because they want to, but because they cannot bear the pain of watching losses deepen. They sell at the worst possible moment, near the cycle bottom. This emotional cycle can be summed up as hope, belief, greed, euphoria, complacency, anxiety, denial, panic, and capitulation. It is a psychological roller coaster, and Bitcoin's volatility amplifies every twist and drop. Some call Bitcoin irrational, but perhaps it is a mirror, reflecting our own impulses more honestly than traditional markets ever could. What makes this dynamic fascinating is that even though people know the pattern, they fall into it anyway. They watch old charts, they read history, they acknowledge that Bitcoin tends to rise after halving, that it forms parabolic tops, that corrections are inevitable. And still, when the next cycle arrives, emotions override knowledge. Why? Because knowing is not the same as living through it. When price climbs fast, greed whispers louder than wisdom. When price crashes hard, fear drowns out memory. But here lies a deeper truth. The cycle is not only emotional individual by individual, it becomes emotional collectively. When enough people believe price will rise, it does. When enough people fear collapse, it collapses. Markets are crowds. Crowds have momentum. Sentiment spreads like wildfire, first small, then unstoppable. Social media accelerates this process. A single rumor, a meme, a viral prediction can add fuel to the fire. Twitter threads, YouTube thumbnails with rockets and moon emojis, TikTok videos promising 100x gains. These shape behavior as powerfully as economic reports. News cycles amplify excitement, then magnify fear. Even institutions are influenced by sentiment. When large funds see momentum, they enter. When panic hits, they hedge, reduce exposure, or short the market. Emotion scales upward through every layer of the system. Yet, amidst this chaos, long-term holders, those who understand cycles, act differently. They accumulate when others are fearful. They sit still during volatility. They are not immune to emotion, but they manage it. They see cycles like seasons. Winter is cold, but necessary. Summer is bright, but temporary. They understand the nature of tides. Their perspective stretches across years, not weeks. And because of them, the Bitcoin network remains stable even during collapse. They are the anchor. To see how psychology plays into the cycle, picture a chart not of price but of emotion over time. In the early accumulation stage, the mood is quiet, sometimes pessimistic. Few are watching. Price moves sideways. Confidence is low. But beneath the surface, something important is happening. Strong hands are accumulating. They are patient. They are builders, believers, students of history. At this stage, Bitcoin feels forgotten. Then slowly, momentum returns. Positive news trickles in. Upward movement becomes noticeable. Optimism awakens. This is the belief phase. More capital enters. Price breaks past previous resistance. Excitement grows. This is where new investors join, not because they understand Bitcoin, but because they see movement. Soon, belief transforms into greed. The market explodes. Everyone wants in. This is the euphoria phase, and it is beautiful but dangerous. Gains seem effortless. Predictions become ridiculous. People quit jobs, take loans to invest, leverage to maximize returns. This is when the seeds of collapse are sown, because price outruns fundamentals and becomes unsustainable. Then reality returns like a cold wind. Profit-taking begins. A negative headline hits. A whale sells. The trend shifts. What was once disbelief becomes denial. Just a dip. But dips deepen. Fear replaces confidence. Those who entered last exit first. Panic spreads. Prices crash. At the bottom, despair reigns. This is where headlines declare the end of Bitcoin. It happens every cycle. And yet, every time, recovery follows. Because while some flee, others accumulate. While fear dominates price, conviction returns among those who understand the long arc. Slowly, the cycle resets. Not by magic, but by human behavior repeating itself. Like waves, like seasons, like breathing. This is the rhythm of Bitcoin. In many ways, studying Bitcoin is less about charts and more about understanding human nature. It teaches patience. It humbles greed. It reveals how emotion drives markets more powerfully than logic. And it reminds us of an uncomfortable truth. People rarely buy when things are cheap. They buy when things feel safe, which is often when they are expensive. They rarely sell when things are expensive. They sell when panic makes them doubt, which is often when prices are lowest. The cycle continues not because people fail to learn, but because emotion is timeless. Technology changes, institutions evolve, but human psychology remains deeply ancient. Now that we have explored the emotional engine of Bitcoin cycles, we must zoom out once again, beyond individuals, beyond online sentiment, into the macroeconomic world, because Bitcoin does not exist in isolation. It breathes within the global financial ecosystem. Interest rates, inflation, liquidity, ETF flows, geopolitical uncertainty, all of these shape Bitcoin cycles too. So let us continue our journey into the next phase: how money flows in and out of Bitcoin during different stages of the global economy, and why institutions are starting to treat Bitcoin not as speculation, but as a store of value. To understand why Bitcoin cycles expand and contract like lungs breathing in and out, we must look beyond the charts and beyond psychology. We must look outward to the world of macroeconomics, traditional finance, interest rates, liquidity, and the shifting tides of global capital. Because Bitcoin does not rise and fall in a vacuum, it moves within a much larger ocean. For many years, Bitcoin was seen as a fringe asset, a curiosity for coders, libertarians, and risk loving traders. Banks dismissed it, governments ignored it, economists scoffed at it. But slowly, something changed. Not because Bitcoin sought their approval, but because the world changed around Bitcoin. After the 2008 financial crisis, trust in traditional systems cracked. People began questioning the nature of money itself. What gives currency value? Why can central banks print more whenever they choose? What happens to ordinary savers when inflation rises and wages do not? The questions were uncomfortable, but they opened the door for Bitcoin to walk through. Over time, we entered a world of unprecedented monetary expansion, quantitative easing, near zero interest rates, stimulus packages, cheap credit, stock markets soaring, not purely from productivity, but from liquidity. In such an environment, investors began searching for assets that could protect value, assets with scarcity. Gold was one option, real estate another. But Bitcoin offered something new: programmable scarcity, borderless accessibility, and independence from any government. As liquidity flowed into global markets, some found its way into Bitcoin, fueling bull cycles. Then, when liquidity was withdrawn, when interest rates were raised, when the economy tightened, risk assets fell, including Bitcoin. It became clear that Bitcoin was not isolated from macro forces. It breathed with them. Risk-on environments, periods of low interest rates and easy money, often lead investors toward growth bets like tech stocks and cryptocurrencies. Risk-off environments, recessions, rate hikes, financial uncertainty, push investors toward stability, sometimes cash or treasury bonds. Bitcoin, still young and volatile, tends to surge when liquidity is plenty and contract when it drains. But a new chapter began to unfold in recent years. Institutions started entering, not quietly, but gradually, deliberately. First, it was hedge funds experimenting with small allocations. Then billionaires like Paul Tudor Jones and companies like MicroStrategy publicly converted cash reserves to Bitcoin, arguing that inflation erodes purchasing power while Bitcoin remains fixed in supply. Tesla announced a Bitcoin purchase. PayPal added crypto services. Suddenly, Bitcoin was no longer a niche. People in boardrooms were discussing it. Yet the most transformative moment arrived with Bitcoin ETFs. For years, institutions wanted exposure, but regulatory and custodial limitations created barriers. ETFs removed those barriers. They made Bitcoin accessible to retirement accounts, pension funds, insurance companies, and large asset managers, entities capable of moving billions, even trillions. For the first time, traditional finance could enter Bitcoin with familiarity and compliance. And they did. ETF inflows became a force, not driven by emotion like retail mania, but by long-term allocation strategies. This changed the cycle dynamic. Institutions tend to hold longer, sell less emotionally, and view Bitcoin as a macro asset, not just a speculative play. They accumulate during uncertainty. They buy dips. They dollar cost average over years. This behavior strengthens floors in the market and deepens liquidity. But institutions are not immune to macro forces either. Their decisions depend on policy. When the Federal Reserve raises interest rates, borrowing becomes expensive, liquidity contracts, and risk assets struggle. When rates fall again, capital seeks returns and Bitcoin becomes attractive. This push and pull contributes to the cycle rhythm. Liquidity in, markets rise. Liquidity out, markets fall. Geopolitics adds another layer. As countries experience currency devaluation, capital controls, or economic instability, adoption often increases locally. When inflation soared in Argentina and Turkey, Bitcoin usage spiked. When Ukraine war tensions rose, crypto donations flowed across borders instantly, something traditional banking could not match as smoothly. In places where trust in government is fragile, Bitcoin becomes not speculation, but necessity. Meanwhile, miners, the backbone of the network, play a role in macro flow too. After each halving, their revenue drops unless price compensates. In bear markets, inefficient miners shut down or sell reserves to survive, increasing selling pressure. In bull markets, miners accumulate and hold, reducing supply. Their behavior contributes to supply shocks that either accelerate or soften cycle movements. Over time, one can see a kind of choreography emerging. Having constrained supply, psychology amplifies emotion. Macro conditions determine capital flow. Institutions bring stability, but also large-scale influence. Governments oscillate between regulation and adoption. Media shifts tone with price. These forces dance together, forming what we call the Bitcoin cycle. It is no longer simply a four-year loop. It is a living system shaped by economics, technology, and human choice. We are now in a world where governments discuss Bitcoin policy, where Wall Street trades Bitcoin ETFs, where banks custody digital assets, and where major companies add Bitcoin to treasury reserves. This was unthinkable a decade ago. The cycle is evolving. It may become longer, broader, more global, or perhaps bursts will still come explosively as retail mania joins institutional capital. The future is uncertain, but one thing is not. Bitcoin is no longer invisible. As adoption grows, volatility may soften. Cycles may remain, but with higher floors and more gradual shifts. Or perhaps new demand shocks, nation-state adoption, financial crises, technological breakthroughs could ignite even larger waves. What does this mean for individuals trying to navigate the cycle? How can someone recognize changing phases before they become obvious? How can one avoid buying the peak and selling the bottom? The answer lies in observation, discipline, and understanding the metrics that reflect market behavior beyond price alone. Because charts do not tell the whole story. Sentiment does not tell the whole story. Macro conditions do not either. But together, they form a map, one that can help investors identify where they stand in the cycle. So in the next part, we will explore how to recognize a Bitcoin cycle while living inside it. We will look at signals, on-chain data, signs of accumulation, signs of euphoria, and the subtle shifts that hint when winter is ending or when summer is overheating. Let us move forward. Understanding the Bitcoin cycle from a distance is easy. Looking back, everything seems obvious. The accumulation phase with low volatility, the slow climb that turned into a rally, the final euphoric peak, and the painful collapse that followed. In hindsight, patterns draw themselves clearly, like footprints on the beach. But living inside the cycle is different. When you are in it, the air is foggy. Fear and excitement distort perception. Logic fights emotion. Noise fills every corner. So how do we recognize where we are without waiting for history to show us later? How can someone look at the moment they are living in and say, this feels like accumulation, or we are entering the expansion phase, or we might be near euphoria? There are no guarantees. Markets are living ecosystems, not clocks. But there are signs, indicators, clues hidden in behavior, on-chain activity, market structure, and sentiment. The cycle leaves fingerprints along the way. We just need to learn how to notice them. Early in a cycle, during accumulation, the market is quiet. Price moves sideways for months. Volatility shrinks. The excitement of the previous bull run has faded. Retail investors disappear. Search volume drops. You no longer hear Bitcoin in everyday conversation. News about crypto barely makes headlines. Some call it boredom. Others call it death. Ironically, this quiet phase is where opportunity often hides. It is when smart money accumulates. Institutions plan long-term entries. Builders innovate without distraction. On-chain data often shows steady inflows to long-term holders, with coins moving off exchanges into cold storage. This phase feels slow, uneventful, but historically, it has been the soil where future rallies grow. Then something subtle shifts. The market shows early signs of awakening. Price begins to climb gradually, forming higher lows. Funding rates stabilize. On-chain metrics reveal renewed activity. Active addresses rise. Exchange reserves decline as holders lock coins away. There is no fireworks yet, only a quiet, steady heartbeat. This is the expansion phase, where confidence returns little by little. Analysts start posting charts again. Small waves of optimism appear on social media. Most people still ignore Bitcoin during this period. It feels uncertain, almost fragile. Yet this is often where long-term positions are established by those who see the bigger picture. As momentum builds, the tone changes. Price breaks past important psychological levels, the previous cycle's high or key resistance zones. Suddenly, media coverage returns. Narratives grow louder. People discuss Bitcoin with new excitement. The cycle accelerates. Institutional inflows increase. ETFs register large buy volumes. Major players announce holdings. On-chain indicators show supply tightening. Long-term holders reduce selling while new entrants increase demand. Volume surges. This phase feels energetic, hopeful. It is the bridge between growth and mania. Eventually, the bridge leads to euphoria. You know when you're there. You can feel it. Everyone is talking about Bitcoin. Taxi drivers, gym buddies, random conversations overheard at cafes. Family members who once mocked it now ask how to buy. Social media is filled with unrealistic predictions. Influencers post rocket emojis. YouTube thumbnails have 100x soon in neon text. New projects launch daily, many with no real value, yet money floods into them. Greed becomes louder than caution. People leverage, borrow, take risks they would never take in calm markets. Gains feel guaranteed. This is the danger zone, where discipline matters more than ever, yet is often ignored. On-chain data often confirms euphoria. Exchange inflows spike as holders prepare to take profits. Funding rates soar. Open interest explodes. New wallets skyrocket. Meme coins pump uncontrollably. Search trends hit peak levels. Headlines proclaim a new financial era. And behind that brightness lurks a shadow, the tipping point, the moment where early profit takers quietly exit. A catalyst, maybe news, maybe regulatory fear, maybe simply exhaustion, triggers the reversal. Prices fall slowly at first, then fast. Optimism turns to anxiety, then to panic. The bear phase begins. During decline, denial is the first reaction. People call the crash temporary. It will bounce. This is just a dip. But dips continue. Liquidations cascade. Fear spreads. Maybe it was a bubble. Confidence evaporates. News turns pessimistic, sometimes hostile. Governments warn. Influencers go silent or switch topics. And those who bought late, overwhelmed by losses, capitulate at the worst moment. This is where price collapses below fair value, driven not by fundamentals, but by emotion, pure and painful. Yet beneath the wreckage, the cycle quietly restarts. Long-term holders accumulate again. Builders keep building. Miners adjust or upgrade hardware. Fundamentals remain intact. Hash rate grows. Adoption continues slowly. And at the bottom, when most have given up hope, the seeds of the next cycle are already in the soil. Recognizing these phases does not guarantee perfect timing. No one catches tops and bottoms flawlessly. The goal is not perfection, but awareness. Awareness helps us act rationally when emotion tries to pull us off course. Awareness reminds us that cycles are natural, not anomalies. That crashes are not endings, but resets. And that long-term conviction often outperforms short-term reaction. This brings us to a deeper reflection. Why do people keep coming back, cycle after cycle? Why does Bitcoin survive every crash, every criticism, every obituary? Why do new believers emerge even after old ones fall away? The answer is complex, but also simple. Bitcoin represents something bigger than price. It represents a shift in how we think about value, ownership, money, and freedom. And for those who see it clearly, the cycle becomes not a threat, but a journey. When I think about the Bitcoin cycle, I don't just see a chart or a pattern. I see a story about hope, fear, greed, belief, and growth. It feels like watching seasons pass over the landscape of human psychology. It feels like watching myself change. Because Bitcoin, for many of us, isn't only a financial asset. It is an experience, a journey, a teacher. And the more time I've spent observing its cycles, the more I've realized that Bitcoin is not just about price, it is about perspective. There was a time when every dip made my heart race, when red candles felt like personal attacks, when green candles felt like destiny. I believed, like many newcomers, that the market owed me something, that if I entered at the right moment, Bitcoin would reward me immediately. But Bitcoin has a way of humbling you. It does not bend to your expectations. It moves with its own rhythm, indifferent to your emotions. And that realization changed me. The Bitcoin cycle taught me that wealth isn't earned in euphoria, it's earned in patience. In the quiet months when nobody is talking about crypto, in the winters after the hype has vanished. That is where character is shaped. It is easy to believe in Bitcoin when everyone else believes. It is much harder to hold conviction when headlines scream, Bitcoin is dead, when friends laugh at the idea of digital money, when your portfolio bleeds and doubt creeps in like cold wind through a cracked window. But every winter eventually turns into spring. Looking back across past cycles, 2013, 2017, 2021, I see the same emotional arc repeating. Not because the market forces it, but because people do. We humans are wonderfully predictable in our unpredictability. We chase what is rising. We run from what is falling. We crave certainty in a world that offers none. And so the Bitcoin cycle becomes more than supply halving and price waves. It becomes a mirror. It shows us who we are. The deeper I've studied the cycle, the more I've come to appreciate it not as a tool for predicting price, but as a philosophy for navigating uncertainty. Understanding the cycle has made me calmer, less reactive, more observant. When the market plunges and panic spreads, I no longer feel the urge to sell everything in fear. I've lived this moment before. I've seen how despair quietly matures into opportunity. When the market soars and people shout about 10x dreams, I no longer feel the need to chase the top. I've seen how euphoria eventually melts into regret. The cycle gave me emotional distance, and that distance is power. There's something profoundly human about watching investors repeat the same behaviors every 4 years. People say, this time is different, yet the rhythm echoes. Accumulation, uptrend, euphoria, collapse, then silence, and again, like the tides, like breath. And in that rhythm, I've learned that the most valuable skill is not predicting what Bitcoin will do next, but managing who I become while holding it. The cycle has also taught me gratitude. Gratitude for volatility, because without it, there would be no opportunity. If Bitcoin moved slowly, calmly, steadily, there would be no stories of transformation, no thrill, no lessons. Volatility is the price we pay for asymmetric reward. It is the tuition fee for understanding markets and understanding ourselves. I've also learned humility. The moment you think you've mastered Bitcoin, it humbles you. The moment you believe the market will only go up, it reminds you of gravity. And the moment you believe it will never rise again, it proves you wrong. It has happened enough times now that I no longer ask, will Bitcoin crash? But instead, how will I behave when it does? Because the true profit is not in predicting cycles, but in preparing for them. And perhaps the most beautiful realization is this: Bitcoin rewards those who think long term. It favors patience over panic, discipline over impulse, conviction over noise. In a world obsessed with shortcuts, Bitcoin feels like the opposite, a long road that tests you before it rewards you. And that road changes people. I've seen friends enter the market full of excitement, only to leave defeated after a crash. I've watched others quietly accumulate during the darkest months and emerge years later with calm smiles and deep understanding. The difference wasn't intelligence. It wasn't luck. It was emotional endurance. It was respect for the cycle. When people ask me now what the Bitcoin cycle means, I don't answer with charts or technical data. I say it means growth. It means learning to stay calm when everything screams panic. It means believing in your strategy more than your fear. It means knowing that winter is painful, but necessary, because winters create strong hands, and strong hands build new summers. If I had to summarize what Bitcoin has taught me, it would be this: the greatest investment Bitcoin gives is not money, but wisdom. Wisdom to question the crowd, wisdom to delay gratification, wisdom to build conviction slowly, quietly, without needing applause, wisdom to hold hope through uncertainty. Because cycles come and go, but who we become through them, that is permanent. No one can say what the next cycle will look like. Maybe it will be larger than anything before. Maybe more volatile. Maybe calmer as institutional capital stabilizes the waves. Maybe it will surprise us in ways we cannot yet imagine. But I am not here to predict. I am here to participate with awareness, patience, and respect. Understanding the Bitcoin cycle does not guarantee success. It doesn't make you immune to loss, but it protects you from the most dangerous enemy in investing, your own emotions. It won't turn you into a genius, but it will stop you from becoming a victim. And sometimes, in markets like this, that's everything. So when I speak about the Bitcoin cycle, I speak not just of price movement, but of a personal journey. A journey from anxiety to understanding, from impulsiveness to discipline, from chasing wealth to cultivating wisdom. Bitcoin may or may not change the world, but it has already changed me. And if you walk with it long enough through storms and sunshine, it might just change you too.